Happy New Year, everyone. In today's video, we're going to review the sector rotations that took place today, the first day of trading in 2024. We'll take a look at how we ended 2023 and where the capital inflows and outflows took place today. Now let's start first by reviewing how we ended 2023. Now we ended 2023 in the index markets either at all-time highs or right near all-time highs. So we saw an almost complete recovery from the past 2 years volatility that has taken place post-COVID. So that was our sign of strength. As we were doing that, however, the put-call ratio, at least towards the tail end of the year, signaled a likely market pullback that was upcoming. We used the 10-period simple moving average, and we saw that our put-call ratio was below the key level of that 0.75 mark, which suggested that we should start to lighten up some of our longs. Now, another thing that stood out was while most sectors were bullish, it was very clear that the defensive sectors were very clear laggards. By defensive sectors, I'm referring to healthcare, I'm referring to utilities, and I'm referring to consumer staples. These are the three defensive sectors, and all three, if you compared the performance to tech or any of the other sectors, industrials, etc., you saw that they were underperforming. Now, knowing all of this, we also saw that for the last 2 weeks of market activity, we had fairly muted volatility. You can see that right down here on our 15-day scanner analytics. This is from our Volatility Box platform, and there we can see very clearly this muted volatility all the way from December 15th to December 29th. In fact, today is that first day that volatility returned, and it returned in spades. It's taking us right back to near that December 14th and December 13th volatility before we went into this period of calm. So this is how we ended 2023. Now let's take a look to see how we started 2024. Today, right out of the gate in the morning, we saw sector rotation away from XLI and XLK, and we saw that money move into XLV, XLP, and XLU, the exact same three defensive sectors that we just talked about. Another sector, which also caught some capital inflows, was XBI, the biotech sector. This happened with both XBI along with IBB, so two different biotech sectors, which suggested a little bit more strength compared to some of our laggards. Now let's review each of these sectors so we can see what these inflows and outflows look like and what we can expect for the shorter term, at least, as we get 2024 kicked off. Now let's start first with the healthcare sector, XLV. Now, healthcare today was the strongest sector in my opinion. Right out of the gate, we came out running. We entirely collapsed our Volatility Box models. For all Volatility Box members, you can go back on your charts and see how many times XLV has done this, and you'll see that it's not that many. That very clearly tells us that capital was flowing into XLV to start off the day, continued to keep flowing here, and our first bearish candle came near 139.05, and even then we had a little bit of a pullback, but still outside of our models. So XLV here, very clear strength. We had it appear two different times on our scanner, both the aggressive and the conservative models breached, and we had some of their top holdings, like Johnson & Johnson, also appear. So healthcare, the strongest sector in my opinion for the day. Second, we had consumer staples. Now here, if we compare the charts of consumer staples to healthcare, you'll see that by that 7 a.m. mark, when healthcare had already broken outside of its conservative models, consumer staples was still inside of its aggressive. It did go outside of its conservative. We still saw a lot of strength inside of consumer staples, but a little bit less when you contrast that with XLV. Now, consumer staples, just like XLV, appeared on our scanner for both the aggressive and the conservative models. Here I have a screenshot of the conservative, and you can also see some of its top holdings that started to appear on the scanner, and we also had the likes of Pepsi and a few others as the day progressed. So XLP, our next sector where we saw some very clear strength, and another defensive sector. Finally, we can look at utilities, the last sector, and out of the three defensive sectors, utilities had the least strength. We still saw strength, but just a little bit less when you contrast that with XLV, which came running out less than 30 minutes into the market, and XLP, which not 30 minutes, maybe an hour or so, but still didn't take as long as XLU to see the same level of strength. XLU also only breached its aggressive models, whereas XLP and XLV breached their aggressive and conservative models. So out of the 3 defensive sectors, in the order that we just reviewed, we had XLV as the strongest or the most inflows coming right out of the gate, then consumer staples, and finally utilities. But all 3 appeared on our scanner and all 3 appeared for short side opportunities, meaning they breached the upper volatility box models. Now let's take a look at biotech, which again, very similar to what we just talked about, broke outside of its aggressive, broke outside of its conservative, gives you an idea of just how much strength we saw to start off. And all of this happened almost less than 30 minutes into the market opened, a little beyond that. So similar strength to what we saw inside of the healthcare sector. Healthcare and biotech went almost hand in hand today. Now let's contrast this with the outflows. And the outflows came really from XLK and XLI today. If we take a look at XLK towards the tail end of the day breached its lower volatility box models. And for all volatility box members, you saw a lot of tech stocks today appear on the scanner. We had stocks like AMD, Intel, Intuit, Snow, Apple even. A lot of tech stocks. You can take your pick based off of whatever you like to trade, but nearly all of them breached their lower volatility box models. The only question was it just the aggressive or was it the aggressive and the conservative models? So very clearly money coming out of tech in today's activity. And if we take a look at industrials here, industrials look similar to what we just talked about in XLK, but not nearly as weak. Inside of industrials, we had the aggressive long models breached, money still flowing out. However, compared to tech, nowhere near the same damage, especially in a lot of the other stocks related to XLI, the top holdings. So now if we come back to what we know with all of the information that we've gathered, here are the clues that I have. We ended 2023 with the put-call ratio signaling an upcoming pullback. We didn't know when or where that might happen, just that, hey, this is a possibility. There's too many people long in the market. We're looking for that put-call ratio to give us some sort of a cooling off period. Now today, to help add to that point, we saw the defensive sectors rallied right out of the gate. So that tells us that, hey, money that was flowing outside of some of the more aggressive growth-related sectors into some of the more defensive sectors, which might lend a hand to this overall idea of the put-call ratio and any kind of pullback. Another thing that I think is interesting is we have earnings as a catalyst right around the corner. So if that propels us into what we think might be happening here based off of these 2 points, well, earnings seems like the most likely catalyst that we can foresee, at least as of right now, with the information and the news that we have. So using all of this, I'm looking at the volatility to continue rising, at least for the shorter term. Today, very clearly, was an increase in volatility compared to almost anything we've seen over the last 2 weeks. It's unlikely that this volatility just disappears, and again, we have earnings coming up, so that might be our catalyst for how volatility continues to increase, at least for the next week and as we go into earnings season. I hope you found today's video useful. Happy New Year one more time. I hope this year is filled with trading success for you, and we'll see you in our next update.